In this session, I'm going to cover the concept of LIBOR and what's going to replace it, the features of the money markets, the products that are traded, their characteristics, and who typically uses them. This is taken from Chapter 5 of your core textbook, Webb and Brahma. Now this chapter, Chapter 5, is 26 pages and thoroughly worth a read, as it covers everything you need to know regarding the money markets and their products. So everything in the lecture slides really is taken from this chapter. Firstly, let's talk about the London interbank offer rate. Up until 2021, this will be the rate that banks will use to underpin most of its money market products, kind of short-term borrowing and lending. But post 2021, it's going to be replaced by a range of different benchmarks, which we'll come on to. Now, the reason for this change links back to post-financial crisis of 2007-8, where there was an accusation and convictions relating to the LIBOR rigging scandal. Prior to this, the British Bankers Association administered LIBOR, which is set daily at 11 o'clock. What the British Bankers Association would do is it would contact all the banks in its panel, and they would say how much they're willing to lend at over a short period. But what was happening was they were contacting an individual in the Treasury department of each bank, but what they may not have realised is the individuals were colluding with their counterparts at other banks to artificially increase the LIBOR rate. Therefore, the LIBOR rate would be higher, and anyone that was going to borrow from the bank would be charged more, which ultimately improves the bank's profitability. And there was a big disconnect between the base rates and LIBOR rates, which signalled there was kind of lack of market liquidity. Following this, and the weekly review into LIBOR, they transformed the process. It was now administered by ICE Benchmark Administration. The kind of different frequency LIBOR is calculated for, and they reduced the number of currencies. Up until 2021, LIBOR was really used for money market pricing. But moving forward, there's going to be a range of different benchmarks to be used. So now, as you can see, LIBOR is calculated for 7 different maturities from overnight to 12 months. So is always less than 1 year. And it's only calculated in 5 currencies. So the rates for the pound, dollar, euro, yen, and Swiss franc. What you can see on the right is a chart to suggest the base rate during the financial crisis being the blue line, and the kind of LIBOR rate overnight being the orange line. And where you can see a big gap or spread, this is normally a good proxy for market liquidity. The larger the gap would suggest that there's less liquidity in the market because banks are charging more to borrow overnight relative to the risk-free rate or the base rate. So these are a few examples of the next kind of benchmarks that are going to replace LIBOR. They're pretty much broken down per country here. So what I'd suggest to get a better understanding of these is to search LIBOR replacements or substitutes to get a deeper understanding of what they are and who will administer them and when they'll be introduced. But the idea is that from 2021, LIBOR will be no more. And here is an example of the global timeline of how the kind of transition from LIBOR to the new alternatives will be. So, the money markets. When we talk about the money markets, what we're referring to is short-term products, meaning less than 1 year, and large wholesale. So money market instruments, or the products we refer to, they're typically traded overnight up to 12 months, and they're on a wholesale very large sums of money. So typically these are traded from the banks, government, really your high net worth individuals. As you can see, the minimum deposit or the minimum transaction is normally typically above £50,000 in the UK. The money markets are seen as very liquid and very safe because the people that issue products tend to be government or large institutions, whether that be financial or commercial. And because the characteristics are very similar, when we talk about money markets, we normally quote them in the term of basis point. So when we talk about 100 basis point, that means 1%. So if interest rates rise by 0.25% or a quarter of a percent, we would say interest rates have gone up by 25 basis points. So that's what we typically talk about when we do money market quotations for interest, because they're very small rates and percentages, so we tend to use the terminology basis point. So just remember, 1% is 100 basis point. I've noted this a few times in my lectures, but in the money market convention, in the UK and Japan, we typically do the calculation for 365 days of the year. But the likes of mainland Europe and America always use 360. If you have to do that conversion between the two, these are the formulas below. Now, the products, they are very examinable. So pay attention to what they are and their characteristics, and always refer back to the reading in chapter 5 of Webb and Bramah. So this could be a typical exam question, one of many. Which of the following cannot be issued by a finance institution? Now the answer to this is B, a T-bill, because T-bill is issued by the Treasury Department in a government. The rest can be issued by finance institutions. So this could be a typical question. So obviously we've got 5 here. We've got the T-bill or Treasury bill, commercial papers or CP. We've got certificate of deposit, banker's acceptance, and the form, which is a bit different, is the repurchase agreement. I'll go through each in turn now. So first of all, the Treasury bill, T-bill. This is short-term debt issued by central governments. What you can see at the bottom there is an example from Bloomberg of where the UK government on this date wants to raise or sell £2 billion worth of T-bills, and that is to be paid back in 28 days' time. So what really happens is they're issued at a discount. So the nominal value is typically £100. The investor will buy it for like £99, and then in 28 days' time, the government will pay back £100. So the investor will have like £1 of interest there. They're the most actively traded security on the money markets because they're liquid, they're the safest. When it comes to lender of last resort, in the form of repurchase agreements I'll go on to talk about, central banks like to buy government debt like the T-bills off institutions in exchange for liquidity because they're kind of seen as risk-free. The likelihood of government's default is low. So always remember, these are issued by the government, they're issued at a discount, then when they mature, the government pay back the par or face value of the Treasury bill. Here's a list of its characteristics, but as noted, it's a discount. You can obviously technically negotiate through the auction, which I'm about to talk about, and the security bearer, which means you don't need to really register, you own it, but in order to trade money market products, you need to be what's known as a gilt-edged trader on the London Stock Exchange, i.e. you're authorised to do so. So that's called gilt-edged via the London Stock Exchange in order to buy or sell Treasury bills. So in the auctions, there's a number of different styles. There's what's known as competitive. This is where people will state how much they want and the price they're going to pay, obviously the price being less than the par value. And when they do this, the government or the debt management office in the UK that deals with this will kind of start from the highest price and work the way down until all of the bonds are being sold. What they'll do though is they'll not say, if someone says £99 and someone says £98 and £97, when they all fill up, everyone pays the lowest price. So if they all fill up with the fourth bidder who bidded £96, everyone will pay £96. If you had someone that bidded £95, then they would lose out. So that's how a competitive bid works. Some will argue it's very similar to like a price drop TV in the UK, if you're familiar with that. An uncompetitive bid is someone that will just say, even though there's a competitive bid going on, they'll have this amount of quantity and they'll pay whatever price. So they take first preference, but obviously they have the risk that the price could be really high or very low. A tender issue is really the government will set out, or central bank will set out the kind of price, and then people will bid to have that in a tender. And it's really the higher bid gets the preference. So this would be a case, if you said 99, you'd pay 99. If you said 98, you'd pay 98. Direct placement is really, will go to certain institutions and they will just be placed straight at them and they'll pay. So it's obviously very uncompetitive and very direct route. And lastly, you can have a public offering. Quite rare because of the sums involved, but you can issue it to the public as well at a fixed price. Commercial papers is another money market product. This is exactly the same product as a T-bill, but it's issued by corporations. So your large firms, it could be banks, but it could also be your large tech firms. So any large credit-worthy company can issue commercial papers. Typically these are from overnight up to 270 days. This is because of US regulation. Anything above that needs to be a bond. So normally this is large institutions which have a high credit rating. Therefore they're kind of seen as safe. If there are corporations that are a bit more riskier, they can go to their bank to get a letter of credit, which tells the investors, if you buy this CP and the company defaults on it, the bank will pay the investor back. Obviously the bank will charge the issuer of the commercial paper a fee in order to ensure this via a letter of credit. Again, here's similar characteristics. Again, issued at a discount. The banker's acceptance, or what's also known as interbank deposits, is really linked to trade. So international trade from exports on a large scale, what normally happens is it's an agreement between two banks to pay one another. Because you may not know, Company X will go to its bank, wants to trade with Company Y, but they don't know who Company Y is. So the bank of Company X will go to the bank of Company Y and say, have they got the sums to pay this money? Yes or no? If so, are you willing to write a letter of credit in case they don't? So the two banks draft up a contract between them that when the goods are delivered, Company Y will pay Company X. And that draft is really a kind of agreement to have one bank pay another bank. And because how trade takes a while, obviously ship going across the world, in the meantime, this agreement or this letter can actually be sold to the secondary market. So if Company X wanted the money sooner, then this letter, the agreement between one bank to pay the other, can then be sold. So Company X can receive the money straight away. Obviously, if they sell it, will sell it less than the par value. So follow the workflow there to understand how it works and read it from the textbook. But this is classed as low risk because technically both banks would have to fail for order of this agreement or this letter to not exist. And there's the characteristics again. Again, issued at a discount, because if you are to sell it in the secondary market, you'd sell it for less than kind of the value of the trade, or the kind of export amount par value. Certificate of deposit is very simply a large retail deposit. So if an organisation receives some money and they want to make a bit of interest on it, instead of just leaving it sitting in a bank account, they can buy a certificate of deposit from a retail bank, which will pay a higher interest. From a bank point of view, this is good for their balance sheets, because it's kind of seen as stable funding over the short term. So if you're an organisation with a large amount of funding, the banks might compete to pay you a higher interest to have this deposit sitting in them, because it helps their balance sheet. So it really is just a large deposit over a short term. This is not issued at a discount. This is kind of interest bearing, i.e. you put 100 million into the bank, then when the certificate deposit ends, the company will get 100 million and 100,000 in return. So they get an interest. And lastly is the repurchase agreement. So this is a typical example of an old school pawn shop, where if you needed short-term liquidity, you'll go to the pawn shop, you will sell them something, so you give them, say your guitar, and they would give you some cash back. Then maybe a month later, you'll go back to buy your guitar, pay a little bit more in return for the guitar. But here's an example from a bank point of view. Typically the lender of last resort, so you do this with a central bank, of all things that were exhausted. But it's not restricted to that. Repurchase agreements happen all the time. It's just the example here is the lender of last resort. So for instance, on day one, a bank goes to the central bank, I'll sell you some T-bills, which are safe. And what you'll say is they'll go, okay, central bank will accept the T-bills and pay the bank some cash for it. Then, in this example, 2 weeks later, the bank will go back to the central bank, can I have my T-bills back, but I'll pay you some more money to receive the T-bills back. So, for the financial institution, they get liquidity here. For the central bank, they earn the difference between the purchase price and the selling price of the T-bill. But obviously they were storing the T-bill in the process. That's why the central bank really likes safe products, because if you bought a risky product, then the central bank also holds the risk of that product bought defaulting as well. So typically they like safe products that are less likely to default. Here's just a very quick example of the yield of how this transaction would work and how the gain would be annualized. So this example is kind of a 2-day scenario, hence why you've got the kind of holding period return times 365 divided by 2 days times 100 to achieve the yield. This table summarizes the characteristics of the money market products. It really is worth understanding this table, kind of try and memorize this in a bit more detail prior to your exam. So who uses the money markets? Well, I said the large organisations, typically the government is the one who issues the likes of T-bills, and the other kind of institutions really use either money markets to invest in for short-term, low risk, low return, or if they want to borrow over a short period, they would do so from the money markets. So here's a few examples of what a bank might borrow, how a corporate might borrow, or what they'd use to borrow. The government obviously borrow via T-bill. And then an example of what if you buy or lend, if you're the investor in T-bills, why would you do this? And what products can you kind of invest in? Noticeably, the government typically don't invest in money market products. They really just issue the money market products. But do bear in mind, everything that's issued of these money markets can be traded on the secondary market. So for a T-bill, the government could issue a T-bill to the investor, but the investor might then sell that to the secondary market to get kind of the price of the T-bill back sooner than just waiting for it to lapse and get the money from the government. So all of these products can be traded on the secondary market, and there's a buoyant secondary market for these products, again due to their safety and the element of liquidity based on these products. And lastly, there's something called the Eurocurrency markets. There's quite an examinable topic. Now, first thing to notice is the Eurocurrency markets were created before the euro existed. So it dates back to 1957. And the purpose for this was to kind of raise currency within a country that's not their own. So if you read this, thus, held in London, Eurocurrency instrument could be denominated in US dollar, yen, Swiss franc, or even euro. So we've got an example of like a sterling, a euro sterling. So that's like a sterling money market product held outside of the UK, like so Frankfurt and Germany. So like so a euro is kind of a money market product priced in euros in America or in Asia. So it's a little bit confusing to understand this first of all, but just remember it's got nothing to do with the euro currency. It means any currency or any product held in currency outside of the domestic country of that currency. So just a quick recap, the likes of euro dollar, that could be raising dollars in the UK. A euro could be going to Australia and raising euros in Australia. So just remember it's got nothing to do with the euro, and it's about raising a foreign currency in your host country. Thank you for watching this summary video. Please do read chapter 5 of Webb and Brahma to get more details, and have a look at many online multiple choice quizzes that are available for the money markets. Thank you.